Welcome, curious minds, to the deep dive. I'm really excited you've joined us today because, well, we're about to plunge into a corner of the digital world that's just so vast, so incredibly fast, it often feels almost invisible, you know?
It really does.
Think about it. Billions with a B of ad opportunities are processed, analyzed, acted upon every single second across the internet. It all determines what you see, when you see it, where you see it.
Mhm.
It's just a mind-boggling scale that really underpins so much of our digital lives.
Absolutely.
Okay, so let's unpack this. You've handed us a truly fascinating stack of research on the trade desk. Now, that's a name you might have seen popping up more and more, especially if you're looking at the future of digital advertising.
Right, TTD.
Our mission today is, well, to sift through this mountain of information, try to connect the dots, and give you a really crystal clear understanding of what this company is, where it stands today, and, where it seems to be headed in this incredibly dynamic landscape.
Yeah, it's moving fast.
You see, the trade desk, or TTD, as it's often called, isn't just another player. It's widely considered a crucial independent force.
That independence is key.
Exactly. In a market that's otherwise dominated by these massive tech giants, those pervasive walled gardens we hear so much about. So today's deep dive is really designed to equip you with a thorough understanding of TTD's unique business model, its competitive landscape, its financial performance, and its ambitious future outlook, ultimately helping you form your own informed conclusions about its truly distinctive place in the modern economy.
Sounds good. Let's get into it.
So let's kick things off with the absolute basics. When we talk about the trade desk, what exactly is it? What's its core identity in this vast digital ecosystem?
Okay, so at its core, the Trade Desk is a global technology company. And what they provide is a sophisticated, self-service, cloud-based platform.
Okay.
And crucially, this platform is specifically designed for buyers of advertising, ad agencies, brands themselves.
Right, the buy side.
Exactly. And what makes them truly stand out, what's absolutely foundational to their identity, is their strategic positioning. Yeah. They are the industry's largest independent demand-side platform, or DSP.
Independent DSP, got it.
And this isn't just, marketing speak. It's fundamental to their whole business model, their strategy.
Oh.
They actively stand apart from the integrated and, as we'll get into, often conflicted walled garden ecosystems.
Yeah.
The ones controlled by giants like Google, Meta, Amazon.
Mm-hmm.
Their sole purpose, their mission, is purely to empower advertising agencies and brands, large and small, to plan, manage, measure, and then continually optimize their data-driven digital campaigns. And they do this across pretty much every imaginable channel and device available on the, quote, open internet.
That independence is a really interesting hook right away, but let's clarify for our listeners. If the trade desk is an independent DSP, what precisely is a DSP in this incredibly complex advertising ecosystem? For someone who just sees an ad pop up on their screen, what's really happening behind that curtain in that millisecond?
Yeah, good question. Think of a DSP as like the ultimate command center for ad buyers.
Okay.
In this intricate, almost dizzying world of digital ads, it's a unified system. It lets these buyers agencies representing brands, or the brands directly manage all their various ad exchange accounts, their data exchange accounts, all through one single powerful interface.
So instead of juggling dozens of logins.
Exactly. No more juggling. They have one control panel.
Yeah.
And the Trade Desk's platform automates and optimizes what's known as programmatic advertising.
Programmatic, heard that term a lot.
Yeah, it's basically the data-driven automated buying and selling of digital ad space.
Right.
You can almost think of it like a high-frequency trading platform, but for ad impressions instead of stocks.
And it all happens at an absolutely mind-boggling speed, right? It's not like the old days of, calling up a magazine rep and booking an ad weeks in advance.
Oh, incredibly fast, yes. The core mechanism here is real-time bidding, or RTV. It's an auction-based model where individual ad impressions, so that single moment an ad could be shown to a specific user on a specific site, are bought and sold within milliseconds.
Milliseconds, wow.
Picture this. When you visit a website or open an app, an ad request is instantly sent out to an ad exchange. The Trade Desk's platform then receives this request, and in that same blink of an eye, it analyzes the opportunity.
Okay.
It evaluates it against the advertiser's specific campaign goals,
Yeah.
their budget, all their target audience data. And if it determines it's a good match, the right person, right context, right price boom, it places a bid.
And if it wins the bid, the ad appears.
Exactly. What's truly fascinating here isn't just the speed, though that's amazing. It's the sheer scale and the data intensity of this whole operation.
Right.
It's not just buying ads. It's a real-time, data-intensive decision-making engine. It determines what ad you see, when, and where, all happening faster than you can blink. Their platform, for instance, is capable of analyzing up to 15 million of these ad opportunities every second.
15 million every second. That's almost incomprehensible.
It's a staggering amount of data processing, yeah.
Yeah.
And decision-making power. It essentially turns guesswork, which used to be a lot of advertising, into surgical precision for advertisers.
Okay, 15 million opportunities a second. That's an almost unbelievable volume. So how does a company operating at that kind of scale actually translate all this technological prowess into revenue? What's their core business model for making money?
Well, their revenue model is actually quite straightforward, and, importantly, it's transparent. It's designed to align their interests directly with those of their clients.
How so?
Which is a key part of their value proposition. Their primary source of revenue comes from a platform fee, and this fee is calculated simply as a percentage of the total amount that a client spends on advertising through the trade desk's platform.
Ah, okay, so it's usage-based.
Exactly.
Yeah.
As clients increase their ad spend, presumably because they're seeing more success and better results from using the platform, the trade desk's revenue grows right along with them.
So TTD is incentivized to make their clients successful.
Precisely. It creates a powerful incentive for PTD to genuinely help its clients succeed. Their success is TTD's success.
Makes sense. Is that the only way they make money?
Well, beyond this core platform fee, they also generate revenue from a variety of what you might call value-added services and data products.
Okay.
These are offerings that enhance the platform's capabilities, basically giving clients even more sophisticated tools. This could include things like fees for accessing specialized third-party data sets from a pretty robust marketplace they have within the platform. Or using premium targeting features that go beyond just basic demographics, or employing their advanced analytics and reporting tools that offer deeper, more granular insights into campaign performance and, crucially, return on investment.
So layering on more sophisticated tools for those who need them.
Right. It's about providing a whole comprehensive suite of tools to make advertisers more effective, basically.
That alignment makes a lot of sense, definitely helps build trust with their clients. So in a world absolutely teeming with ad tech companies, what's the trade desk's truly unique selling proposition? What's their core value that really makes them stand out and, hopefully for them, provides a lasting advantage?
Yeah, their core value proposition is really built on three foundational pillars that differentiate them pretty sharply from much of the industry: objectivity, omnichannel reach, and data-driven intelligence.
Okay, let's break those down. Objectivity first.
Let's start with objectivity and independence, because that is truly their most crucial differentiator. The Trade Desk is a pure-play, independent technology provider. What that means, fundamentally, is they do not own any media, any content, or any ad inventory themselves. They are purely a tool for the buyer.
Okay, here's where it gets really interesting. You bring up a fascinating point about independence. To put it in perspective, it's almost like if a referee in a big game also owned one of the teams playing, right? How much would you truly trust their calls? Is that the fundamental conflict TTD is trying to dismantle with this independence?
That's a perfect analogy, yes. That structural independence eliminates the inherent conflicts of interest that are just pervasive within those walled garden platforms we've mentioned.
Right. Google, Meta, Amazon.
Exactly. Those giants own vast media properties. Think Google search, YouTube, Facebook, Instagram, Amazon's product pages, and therefore they operate on both the buy side and the sell side.
Ah, okay.
So their platforms are naturally incentivized to prioritize their own inventory, potentially at the expense of what might actually be the absolute best, most cost-effective option for the advertiser somewhere else across the broader internet.
So TTD just says, we'll help you find the best spot wherever it is.
Precisely. By acting solely and exclusively on behalf of the ad buyer, the Trade Desk can objectively help clients select the most effective and efficient ad placements across the entire open internet, always prioritizing the advertiser's specific campaign goals and maximizing their return. This truly fosters a level of trust and transparency.
Which advertisers must crave.
Absolutely. Especially as ad spend becomes a larger and larger line item for many businesses, they're demanding more and more accountability.
Okay, so objectivity is pillar one. What's the second?
The second pillar is omni-channel reach. Their platform provides a unified, centralized interface for planning, executing, and measuring campaigns across the full, diverse spectrum of digital advertising channels.
So not just website banners.
Oh, far beyond that. It includes traditional display advertising, sure, but also compelling video ads, audio like streaming music and podcasts, native advertising that kind of blends into content, digital out-of-home, those sophisticated digital billboards you see now,
Yeah.
and of course, mobile advertising. And most significantly, they've really established themselves as a leader in connected TV, or CTV.
CTV, that keeps coming up.
It's huge. They provide advertisers with unparalleled access to premium streaming inventory from major providers around the globe. So this comprehensive omni-channel capability allows advertisers to orchestrate truly cohesive campaigns that can reach consumers seamlessly across multiple touchpoints in their often fragmented digital journey. It creates a more unified brand experience.
On it. Objectivity, omnichannel. What's the third pillar?
And finally, number 3 is data-driven decisioning. The platform is meticulously engineered to ingest, process, and analyze just vast amounts of data from those billions of ad opportunities per second we talked about, down to granular campaign performance, all to inform every single advertising decision.
How does that work in practice?
Well, advertisers can securely upload and activate their own valuable first-party data.
Yeah.
Things like customer lists from their CRM system, purchase history, website visitor data, that kind of
Our
thing.
own secret sauce. Exactly. And this can then be combined with a large marketplace of third-party data providers that TTD offers access to, allowing for incredibly precise audience targeting based on demographics, interests, behaviors, even real-time purchase intent signals.
Oh, wow.
What's more, the platform's robust measurement and reporting tools allow advertisers to attribute business outcomes, things like online sales, app downloads, or even verified in-store visits directly to their ad spend. This offers very clear, measurable visibility into campaign ROI that was, frankly, much harder to achieve historically.
So closing that loop between spending money and seeing results.
Exactly. This whole holistic data approach drives efficiency and effectiveness.
Got it. So they're building this incredibly powerful, objective, omni-channel platform, and they're doing it with a global vision. Where is the trade desk primarily based, and how far have they actually spread their wings geographically across the world?
Yeah, they're headquartered in Ventura, California, which is actually a bit of an outlier for a major tech company, not Silicon Valley.
Yeah.
But they absolutely maintain a significant global presence. They have offices strategically located across North America, Europe, and the Asia-Pacific region, and they're continuously expanding their operational footprint.
But is most of the business still in the U.S.?
For now, yes. While the United States currently constitutes the vast majority of their business, it accounted for about 86% of gross billings, meaning the total ad spend processed through their platform. In their most recent filing, international expansion remains a key strategic focus for their long-term growth.
Okay.
They've been making substantial, targeted investments to build out local teams, refine their technology for specific market needs, and establish the necessary infrastructure in key international markets. They really want to serve the unique demands of global advertisers, knowing that a truly open internet is, well, a global one. ##2. Navigating the evolving landscape of digital advertising.
Now that we understand what the trade desk does, this powerful command center they've built, let's maybe zoom out a bit and look at the broader battlefield. This company operates in a truly massive, constantly shifting, and incredibly competitive industry. What's the overall size of the market they're playing in, and how fast is it really growing?
Yeah, zooming out is important. The trade desk operates within the global advertising market, which is, well, an industry estimated to be approaching a staggering $1 trillion in total annual spend.
$1 trillion. Wow.
Yeah, just to put that in perspective, that's roughly the GDP of a country like Indonesia or Mexico. It's huge.
Yeah.
But their specific focus is on the rapidly growing segment within that, which is programmatic advertising.
Right, the automated, data-driven part.
Exactly, the automated, data-driven purchase of ad space we discussed. Now, interestingly, forecasts for the size and growth of this programmatic market, they vary quite significantly.
Oh, how so?
Which often reflects different methodologies and, crucially, different definitions used by market researchers.
Give us some of those numbers. How wide is this range of estimates, and what does that tell us?
They are indeed wide, and it gives you a good indication of the market's complexity, maybe even some confusion. For example, one report estimates the global programmatic market will expand from about $26.7 billion in 2024 to $370 billion by 2034. That's a compound annual growth rate, a CGR, of over 30%.
Huge growth.
Huge. But then another projects grow from $42 billion in 2023 to maybe $306 billion by 2033 at a, say, 22% CDR. More conservative estimates might suggest a market size of $111 billion in 2024, growing to $324 billion by 2033. That's more like a 12.5% CGR.
Still strong growth, but a big difference.
A big difference. And then at the really far end, the widest forecast actually projects a market of $811 billion in 2024, growing to over $3.1 trillion by 2034.
Whoa, okay, $3 trillion. Those are absolutely huge differences in projected market size, some varying by hundreds of billions, even trillions of dollars. Why such a massive variance in these numbers?
Yeah, it's pretty wild. The significant variance likely stems from how each research firm defines the term programmatic market.
Ah, the definition matters.
It matters a lot. Broader definitions might basically encompass nearly all digital advertising, including the vast ad spend within the walled gardens, like all the search and social media advertising on Google and Meta.
Okay.
Whereas narrower and arguably more relevant definitions for understanding the trade desk's specific opportunity tend to focus specifically on the open internet. That includes display, video, and crucially, connected TV, which is really TTD's primary domain.
Right, outside the big walled gardens.
Exactly. But look, regardless of the precise figure or the definition used, the consensus across all these reports is unequivocally clear. It's a large, rapidly expanding addressable market, and it's driven by the ongoing, unstoppable digitization of media consumption. Where eyeballs go, ad dollars naturally follow. It's a massive tailwind that's just hard to ignore for a company like TTD.
Okay, so a huge and growing market, even with some, let's say, definitional squiggles. Let's dig into some of the specific trends powering that growth, because that's where the real shifts are happening. What's one of the biggest, most impactful shifts happening in advertising right now that TTD seems perfectly positioned for?
Oh, without a doubt, the most powerful secular trend benefiting the trade desk right now is the structural shift of viewership and consequently advertising dollars away from traditional linear television, cable and broadcast, and towards connected TV or CTV.
CTV again. Okay, tell us more.
This isn't just like a slight adjustment. It's a profound generational replatforming of television itself. CTV advertising spend in the U.S. is just on a steep upward trajectory. It's projected to increase from roughly $27 billion in 2023 to nearly $47 billion by 2028.
Wow, nearly doubling.
Yeah. And this migration is fundamentally fueled by consumer behavior, right? The phenomenon everyone knows as cord cutting, where viewers are abandoning traditional paid TV subscriptions in favor of streaming services like Netflix, Hulu, Disney+, SETI, all of them.
Right. Everyone's streaming now.
Pretty much. As of June 2025, streaming now accounts for a staggering 46% of all TV viewing time in the U.S. That actually surpassed both broadcast and cable television combined.
That's a tipping point.
Huge tipping point.
Yeah.
And this has created a massive new pool of premium, high-quality, ad-supported video inventory. It offers advertisers the reach of traditional TV, but with the targeting precision of digital. Best of both worlds, in theory.
And how does this connect specifically to programmatic and TTD?
Crucially, the method of transacting this inventory has fundamentally changed. Unlike the old manual relationship-based ad buys that defined linear TV for decades.
The Mad Men days.
Exactly, the Mad Men days. CTV advertising is overwhelmingly programmatic. Projections indicate that over 84% of all CTV ad spend will be transacted programmatically in 2025.
84%.
Yeah, and this plays directly, powerfully to the strengths of the trade desk's data-driven, automated platform. It's truly a perfect storm of opportunity for them. They were built for this shift.
That's a huge shift, basically changing how TV advertising works from the ground up, making it much more like online advertising. What's another major, rapidly emerging trend impacting the digital ad landscape, one that also seems to rely heavily on data?
A second major industry trend, and one that's also experiencing just explosive growth, is the emergence of retail media networks, or RMNs.
RMNs, okay.
This segment is projected to become a $100 billion market in the U.S. alone by 2028. Growing from approximately $60 billion in 2025.
$100 billion just for retail media.
Yeah. RMNs are essentially advertising platforms operated by major retailers, think giants like Walmart, Target, Kroger, or even delivery services like Instacart. They allow brands to advertise directly on the retailer's own websites, their apps, and increasingly actually using the retailer's data across the open internet too.
Why is this taking off now?
Well, the primary driver is the immense value of first-party shopper data. Retailers possess this wealth of proprietary granular information on consumer purchasing habits, what you bought, when you bought it, how often, what other items you looked at.
Stuff Google and Facebook don't necessarily know.
Exactly. It's actual purchase data. And this data is incredibly valuable for precise ad targeting. So by creating their own media networks, retailers can effectively monetize this data asset. And brands. They can reach consumers directly at or near the digital point of sale, thereby linking ad spend directly to product sales.
Ah, the holy grail of measurement.
Pretty much.
Yeah.
This creates a powerful new advertising channel that offers what's known as closed-loop measurement, which has long been a sought-after, almost mythical goal for marketers, especially CPG brands.
CPG, consumer packaged goods.
Right. Think soap, cereal, soda. It means you can literally see if your ad on, say, Walmart's site led directly to a sale of your product at Walmart.
That's powerful.
It really is. And if we connect this to the bigger picture, you see both CTV and retail media represent a fundamental, undeniable shift in how advertisers reach consumers. It's moving decisively away from broad strokes and generic messaging towards incredibly precise, measurable engagements. And that's precisely where data-driven DSPs like The Trade Desk shine. They are perfectly positioned right at the intersection of these two megatrends.
So we have these massive growth opportunities, these powerful tailwinds in CTV and retail media. But the digital ad world is rarely simple or without its challenges, right? What are some of the major headwinds and maybe foundational shifts facing the industry right now, especially on the regulatory and technology fronts, that could derail even the best laid plans?
Yeah, absolutely. It's not all smooth sailing. The digital advertising industry is actually undergoing a truly foundational technological and regulatory shift with the deprecation of the third-party cookie.
Ah, the death of the cookie. We hear about this constantly.
Constantly. And it's not just an update. It's really a dismantling of a core piece of internet infrastructure as we've known it. For years, these little text files placed in web browsers were the primary mechanism for tracking users across different websites, enabling much of the personalized ad targeting and measurement we've all grown accustomed to, maybe even taken for granted.
But privacy concerns changed everything.
Exactly. Mounting consumer privacy concerns have led to new, stringent legislation, like Europe's GDPR, the General Data Protection Regulation, and the California Privacy Rights Act, CPRA, right here in the U.S. And these concerns have also prompted browser makers like Apple with Safari and Firefox to block third-party cookies by default. And Google, whose Chrome browser dominates the market, has committed to phasing them out entirely by the end of 2024.
So what does this all mean? We're truly at a crossroads. The very foundation of how online advertising has operated for, what, decades? It's changing drastically, but it's happening at the exact same time as these massive new growth areas like CTV and retail media are exploding. It feels like a moment of immense disruption and opportunity all at once.
Precisely. That's a great way to put it. This cookie deprecation dismantles the infrastructure that underpinned much of the open internet's advertising model. It's forcing the entire industry to rapidly develop new privacy-conscious methods for identifying users and measuring campaign effectiveness.
Which sounds hard.
It is. It creates a significant challenge for the entire ecosystem. It's kind of like trying to rebuild the engine of a car while it's still speeding down the highway.
Oh.
But it also presents a huge opportunity for companies that can provide viable, future-proof alternatives. The industry is now rapidly shifting its focus towards leveraging advertisers' own valuable first-party data.
Like the retailers have.
Exactly. And developing new consented identity solutions. Things like the Trade Desk's pioneering Unified ID 2.0 initiative, or UID2, which aims to be an open-source, industry-wide standard to replace the cookie.
Okay, UID2. We'll come back to that.
Yeah. And here's where it gets particularly interesting, that convergence you mentioned. The industry's greatest challenge, the widespread loss of the third-party cookie, coincides directly with the rise of its greatest growth opportunities in CTV and retail media.
How so?
Well, these new channels, CTV and retail media, are, by their very nature, inherently less dependent on third-party cookies. They're often built around authenticated user data, right? Like your login for a streaming service or your loyalty account for a retailer.
Ah, so they have their own ways of identifying users.
Exactly. This creates a dynamic where the platforms best positioned to capitalize on these new high-growth channels like TTD are also the ones best insulated from the disruption happening in the traditional web environment caused by cookie loss. So the trade desk's early and sustained investments in building robust capabilities and forging deep partnerships in both CTV and retail media, while simultaneously championing a new privacy-centric identity framework like UID2, really demonstrate, I think, a strategic foresight. It places them right at the nexus of these transformative industry shifts. They're not just reacting, they're actively trying to architect the future.
Okay, so with these massive trends at play, both tailwinds and headwinds, how does the trade desk actually stand out and build a, defensible position against its truly formidable competitors, especially those giant walled gardens we keep mentioning? What's their unique competitive moat that protects them?
Yeah, the moat question is central. Their competitive strategy is fundamentally defined by its positioning against those industry giants, Google, Meta, Amazon. Their differentiation is built squarely on those principles we discussed: objectivity and transparency, which directly address what many advertisers see as the primary shortcomings and inherent conflicts of the walled garden model. The core of this differentiation lies in their business model. TTD exclusively serves the buy side of the advertising transaction.
Just the buyers.
Just the buyers. It sells technology, powerful software to help advertisers buy media more effectively, and critically, it does not own any media properties or content platforms itself. They're solely focused on the advertiser's success.
So just to reiterate, if I'm an advertiser, that means no conflict of interest because TTD isn't trying to push me towards their own ad space, maybe because they need to fill it. They're just helping me find the best space wherever it happens to be on the open internet.
Exactly right. That's the core promise. This contrasts sharply with walled gardens, which, as we said, operate on both the buy side and sell side. They own vast inventories of ad space: search, YouTube, Facebook, Instagram, Amazon pages, and they also provide the tools for advertisers to buy that space.
Got it.
That dual role creates an inherent conflict of interest. Their platforms are naturally incentivized to prioritize their own inventory, potentially at the expense of what might actually be the best ROI for the advertiser elsewhere.
And TTD offers more transparency too, you mentioned.
Yeah, that's the other side of the coin. The trade desk provides advertisers with granular, real-time data and reporting. They offer full transparency into media costs, specific ad placement details, campaign performance metrics. This open approach is a direct counterpoint to the often black box nature of walled gardens.
Black box, meaning you don't really know what's going on inside.
Exactly. They often provide very limited data and restrict advertisers' ability to independently verify performance or even use their valuable first-party data outside of that closed ecosystem. So as advertisers become more sophisticated, demand greater accountability for their often massive ad spends. And as regulators increase scrutiny of anti-competitive practices in digital advertising, this commitment to objectivity and transparency becomes an increasingly potent competitive advantage. It really fosters trust and loyalty.
Okay, that makes sense from a strategic business model perspective.
Yeah.
But beyond just their positioning, what about their actual technology? Does their platform offer unique, cutting-edge advantages that set them apart from a purely technical standpoint?
Absolutely. They don't just rely on the positioning. The trade desk complements that strategic independence with a sophisticated and proprietary technology stack that is constantly evolving. The company's recent and really monumental platform overhaul, branded Kokai, represents a major step forward. It deeply integrates its artificial intelligence engine called Koa into literally every aspect of the media buying process. This wasn't just like a fresh coat of paint. It's a fundamental reinvention of the user interface and the underlying algorithms. And it's designed to significantly enhance automation, forecasting accuracy, and optimization capabilities.
And does it work? Are clients seeing results?
The tangible benefits for clients seem quite significant based on what they've reported. Clients who have transitioned the majority of their ad spend to Kokai are apparently increasing their overall platform spend more than 20% faster than those who haven't.
Wow, that's a big difference.
It is. And maybe even more importantly, campaigns running on Kokai are delivering substantial performance improvements. They're setting things like an average 27% lower cost per acquisition, or CPA.
CPA. So cheaper to get a new customer or a sale.
Exactly. Which is a massive win for advertisers. That directly impacts their bottom line.
What's under the hood that enables that kind of performance gain?
Well, beneath that user-facing Kokai platform lies a proprietary bid factor-based architecture.
Bid factor architecture, okay.
This is where the real granular magic happens. Think of it like an ultra-fine-tuned control panel, far beyond just a simple on-off switch or a few broad settings like target sports fans. Instead, PTD lets advertisers apply tiny, real-time multipliers for countless specific variables. For example, maybe a 5% increase in the bid for a sports fan who was watching a live game on a Tuesday night in New York City, who recently visited a specific sports apparel website and is viewing on an LG Smart TV.
Whoa, that's incredibly specific.
It's micro-targeting on a scale, and with a level of precision that most legacy DSPs, with their more rigid sort of line item structures for campaign management, just can't really match. This proprietary tech gives advertisers incredibly precise surgical control over their ad spend at an almost atomic level, maximizing efficiency and impact.
That's powerful. So how do all these factors, the independence, the advanced AI, and COA and COCAI, this granular bid factor control, how do they combine to create those lasting economic moats, the things that make it incredibly hard for competitors, even the giants, to catch up, let alone surpass them?
Yeah, it's the combination that really builds the moat. The Trade Desk's durable competitive advantages are derived from a powerful interplay of a data-driven network effect and high customer switching costs.
Okay, network effect first. How does that work here?
The platform benefits profoundly from a potent data network effect. Think about it. As more advertisers run more campaigns through the platform, the Trade Desk continuously accumulates a truly vast and proprietary data set.
Right, from those 15 million opportunities a second.
Exactly. Data on which ad impressions, in which contexts, and for which audiences actually drive specific measurable outcomes like a click or a purchase. This unparalleled volume of real-time data continually trains and refines its COA AI engine.
Making it smarter over time.
Precisely. This data makes the platform's algorithms smarter, more predictive, more efficient, which in turn delivers consistently better ROI for advertisers.
And better ROI attracts more advertisers.
Exactly. This superior performance then attracts even more ad spend to the platform, which generates even more data, creating a self-reinforcing virtuous cycle. It's incredibly difficult for smaller or newer competitors who don't have that scale of data to replicate. It's a flywheel that just builds momentum with every transaction.
That sounds like an incredibly powerful flywheel, almost an unfair advantage once it gets going. Does that mean it becomes increasingly difficult for any new player to ever catch up to TTD's data moat? Or are there ways around it? Could an advertiser just switch platforms easily?
That's an excellent question, and it really gets to the heart of the moat, particularly the second part, switching costs. While it's technically pretty simple for an advertiser to use multiple DSPs, they often do to some extent.
Right.
The practical switching costs away from the Trade Desk, especially once an advertiser is deeply integrated, are quite substantial.
Why is that?
Think about an advertiser's entire history on the Trade Desk platform. All their past campaign data, the custom-built audience segments they've created, the specific algorithm optimizations the AI has learned for their campaigns, even the unique ways their own valuable first-party data has been integrated and activated. All of that represents a significant intellectual asset. Migrating that whole operation to a new platform would mean abandoning all this accumulated intelligence and essentially starting the optimization process from scratch.
Which sounds painful and expensive.
Incredibly costly, yeah, both in terms of time and, more importantly, lost performance during the transition. And then there are the practical barriers and costs associated with retraining teams on a completely new interface, reintegrating all their first-party data and measurement systems, rebuilding trust in the new platform's algorithms. For many large advertisers, it's just too disruptive and risky.
That 95% client retention for over a decade, that's not just good, it's almost unheard of, especially in the tech and software world. It tells you something powerful about the value and stickiness of their platform, right? That advertisers would rather weather a small hiccup than completely uproot their entire advertising operation.
Indeed. It's a remarkable statistic. These high practical switching costs are the primary driver of the Trade Desk's exceptionally strong customer loyalty. And that metric, that 95% plus retention for 11 consecutive years, is probably the strongest single piece of quantitative evidence for the existence of a truly durable economic moat.
Right.
So this raises that important question you ask. How difficult is it for a newcomer to replicate this? The interplay of the proprietary data fueling the AI, the trust fostered by their independent model, the embedded intelligence from COA, and the superior performance creating those high switching costs. It all creates a truly formidable competitive barrier. It's a deep moat indeed, and one that arguably deepens with every additional dollar spent and every new data point collected on the platform.
It sounds like each piece reinforces the others.
Exactly. The independent business model fosters trust, which brings in clients and data. The vast data fuels the network effect and powers the AI. The superior performance from the AI and tech creates high switching costs, locking clients in. It's a structure where each element reinforces the others, creating a durable and potentially widening competitive advantage that few can easily match.
That's a powerful picture of their competitive advantages and how they've built such a sticky platform. But, how does all this translate into their actual financial performance? Because ultimately, for any company, the numbers have to back up the strategy, right? What does the trade desk's financial health look like?
Yeah, absolutely. The numbers are crucial. And the trade desk has established a really impressive track record of exceptional financial performance. It's truly characterized by rapid, consistent revenue growth, high and stable gross margins, significant operating leverage as they scale, and robust free cash flow generation. This performance truly reflects the inherent scalability of its software-based platform model and their successful execution in capturing an increasing share within that rapidly growing programmatic advertising market we talked about. It's frankly a financial profile that many software companies would envy.
Let's look at that revenue growth first. In an industry that can be quite cyclical, as we know advertising can be, how fast have they actually been growing, and what's driving that consistently?
Yeah, they've consistently delivered high rates of revenue growth, significantly outpacing the broader advertising market overall. That's a clear testament to their market share gains and their exposure to those high-growth segments like CTV.
Give us some specifics.
Okay, specific figures. Revenue increased impressively from $836 million back in fiscal year 2020 to $2.45 billion in fiscal year 2024.
Wow, nearly tripled in 4 years.
Exactly. That represents a compound annual growth rate, or CAGR, of 30.8% over that period. Growth has remained strong even more recently, with revenue increasing 23% in fiscal 2023 and actually accelerating slightly to 26% in fiscal 2024.
Acceleration is good to see.
It is. And in the most recently reported quarter, Q2 2025, revenue grew a solid 19% year over year to $694 million. This sustained growth is really a direct result of a few things. Increased ad spend from their existing clients, that stickiness we talked about, the successful acquisition of new clients, both large and small, and the company's strategic expansion into those high-growth channels, especially connected TV and retail media, they seem to be hitting all the right notes for growth.
Okay, beyond just that impressive top-line growth, what about profitability? Are they actually making substantial money from all this revenue, and are their margins healthy enough to sustain this kind of growth going forward?
Absolutely. That's a key and sometimes overlooked feature of the trade desk's financial profile, its high profitability. It really underscores the economic leverage inherent in their software-based model. Their gross margin has been consistently high and stable, typically ranging between 79% and 82% for the last 5 years.
80% gross margin, that's very high.
Very high. That's characteristic of best-in-class software companies, and it indicates strong pricing power and a very efficient cost structure for delivering its platform services.
And below the gross margin line, operating profit.
Looking at operating and EBITDA margins. EBITDA being earnings before interest, taxes, depreciation, and amortization, a common measure of operating profitability. The trade desk has consistently demonstrated its ability to translate that strong revenue growth into robust operating profit. The company often highlights its non-GAAP adjusted EBITDA margin.
Non-GAAP meaning adjusted for things like stock compensation.
Exactly. It excludes certain non-cash items like stock-based compensation, which provides arguably a clearer picture of the underlying operational performance. That adjusted EBITDA margin has been a key metric, registering a very healthy 40% in fiscal year 2023 and even expanding further to 41% in fiscal 2024.
41% adjusted EBITDA margin. That's impressive.
It really is. For Q2 2025, the adjusted EBITDA margin was still a strong 39%. This level of profitability is a testament to the platform's scalability. As they add more revenue, the incremental costs associated with that revenue are relatively lower. It's truly a very efficient, profitable machine.
So they're growing fast, they're highly profitable. How does that translate into cold, hard cash flow, which, as you know, is often seen as the ultimate measure of a company's financial health and flexibility?
Yeah, cash is king, right? And the company is a prolific generator of free cash flow, FCF, which is indeed a critical indicator of financial health and operational flexibility. Free cash flow for fiscal year 2023 was an impressive $551.5 million, and that grew further to $641.2 million in fiscal year 2024.
So generating over $500 million in free cash annually.
Right. This strong, consistent cash generation ability provides the company with ample internal resources. They can fund their aggressive growth initiatives, invest heavily in research and development like for Kokai and Ventura, and execute their capital allocation strategy, maybe acquisitions or buybacks, without having to rely heavily on external financing like debt or issuing more stock. That provides a significant advantage, especially in uncertain economic times. It gives them tremendous strategic flexibility.
Okay, but beyond the traditional financial statements, revenue, profit, cash flow, what are the most important key performance indicators or KPIs that really tell us how well the trade desk is actually performing day to day, especially in terms of market penetration and that client loyalty we kept talking about?
Yeah, there are two primary KPIs that really illustrate the scale and, maybe more importantly, the stickiness of the trade desk's platform. First is gross spend on platform. This metric represents the total dollar value of advertising that flows through their platform. It's a leading indicator not only of their future revenue growth, but also of their increasing market share within the overall programmatic ecosystem.
And how has that been trending?
Gross spend has expanded dramatically. It went from $4.2 billion back in 2020 to a record $12 billion in 2024.
Wow, nearly tripling in 4 years, just like the revenue.
Exactly. It shows significant client adoption and, crucially, increasing budget allocation from those clients to the trade desk's platform. They're winning a larger share of their clients' wallets.
It's one thing to talk about a strong business model, but these numbers really paint the picture, don't they? Especially when you pair that spend growth with that client retention rate. It's a powerful testament to how deeply embedded they become with their clients, almost indispensable in some ways.
Absolutely, and that leads directly to the second, equally crucial KPI, client retention. As we noted earlier when discussing their economic moat, the company's client retention rate has remained remarkably above 95% for the past 11 consecutive years.
11 years above 95%.
It's an exceptionally strong figure for any industry, let alone a dynamic tech sector like ad tech. And it serves as the clearest quantitative evidence of the platform's profound value proposition and those high switching costs experienced by its clients. These KPIs, alongside the strong revenue growth and consistent profitability, demonstrate a robust, expanding, and incredibly sticky business that is not just surviving, but clearly thriving in a complex and competitive market.
Okay, now let's look forward. The financials are strong, the moat seems deep, but the market never stands still, right? What are the trade desk's main strategic growth pillars and their overarching vision for the future? How are they planning to not just compete, but truly architect the future of this industry, as you put it earlier?
Yeah, looking forward is key. The trade desk's corporate strategy is truly laser-focused on capitalizing on the major secular trends reshaping the advertising industry while simultaneously trying to shape those trends themselves. They're not just riding the wave, they're trying to steer it. They're pursuing growth through a multi-pronged approach. It includes deepening their leadership in those high-growth channels like CTV, expanding their international footprint, and, quite ambitiously, driving industry-wide innovation to become, essentially, the foundational layer for the future of the open internet.
And as we discussed, connected TV is just this massive transformative opportunity. How central is CTV specifically to their strategy, and what are they doing to truly dominate that space beyond just having access?
Well, CTV is absolutely central. It's consistently cited by management as the core pillar of the trade desk's growth strategy. It's not just their largest channel now, but also their fastest growing channel. Video advertising, which is predominantly CTV for them, now accounts for a high 40s% of the total ad spend on their platform.
Almost half their business is video CTV now.
Almost half, which demonstrates its increasing importance. Their strategy involves forging deep, direct partnerships with virtually every major ad-supported streaming service and platform. You can think of big names like Disney, Hulu, Peacock, Roku, Netflix for its ad-supported tiers, even smart TV manufacturers like LG. They want to be wherever premium video inventory exists.
But they're going beyond just partnerships, right? You mentioned something called Ventura.
Exactly. A truly key and quite ambitious strategic initiative in this area is the November 2024 announcement of Ventura. This is a brand new streaming TV operating system, or OS.
Their own TV operating system, like Roku OS or Google TV.
Essentially, yes. By developing its own OS to be licensed directly to TV original equipment manufacturers, the OEMs, the trade desk aims to move even deeper into the CTV ecosystem. The stated goal of Ventura is twofold. First, To improve the consumer experience, make TV viewing smoother, more personalized. And second, simultaneously create a more efficient and transparent advertising supply chain specifically for CTV, directly challenging the incumbent OS providers in this space like Roku, Google TV, maybe even Amazon Fire TV.
Wow.
This Ventura initiative is more than just another product launch. It's a really strategic move to influence the very infrastructure of CTV itself. It's TTD trying to move beyond being just a key player in the ecosystem to becoming an architect of it, potentially controlling a fundamental layer of the future TV experience.
That's an incredibly ambitious move, essentially trying to build and own the operating system for smart TVs. You also mentioned their global ambitions earlier. How big of a growth driver is international expansion really for them, especially given the U.S. currently accounts for such a large portion of their billings?
Yeah. While North America remains their core, most mature market, the trade desk views international expansion as a critical long-term growth driver that still holds immense untapped potential. And we're seeing signs it's working. In recent quarters, international growth has actually outpaced that of North America, signaling successful execution overseas.
Okay.
The company continues to execute its global playbook, primarily led by the expansion of CTV advertising in overseas markets. In many places, cord-cutting and streaming adoption often mirror or sometimes even accelerate beyond U.S. trends.
Right.
So they've been making targeted investments to establish a physical presence, build local teams who understand the nuances of those markets, and adapt their platform and services to meet specific regional needs and navigate diverse regulatory landscapes in key markets across Europe and Asia. The goal is clearly to replicate their U.S. success on a global scale, truly building an open internet advertising infrastructure that spans continents.
We also talked about retail media being this huge growth area, fueled by that invaluable first-party shopper data. How is TTD approaching that market to ensure they capture a significant piece of that $100 billion pie?
They are aggressively pursuing the retail media opportunity, yeah. They're positioning their platform as the central hub for activating that valuable shopper data across the open internet, not just confining it to the retailer's own website or app.
So using Walmart data to target ads on, say, ESPN.com.
Potentially, yes, if the agreements allow for it. They're forging strategic partnerships with a growing list of major retailers, including giants like Walmart, Home Depot, Instacart, and others. These integrations allow brands to securely use the retailer's first-party data for incredibly precise audience targeting and, crucially, to measure the direct impact of their advertising campaigns on actual product sales.
That closed-loop measurement again?
Exactly. That capability is a powerful value proposition, especially for those consumer packaged goods, CPG brands, and other advertisers seeking to directly prove their return on ad spend. It effectively allows a CPG brand to, say, target an ad to someone who bought a competing brand's product last week and then see if that ad led them to buy their product this week. That's absolute gold for marketers.
So they're capitalizing on these major trends, CTV, international, retail media, but they're also, as you said, deeply involved in shaping the future of the entire industry, especially as we move beyond third-party cookies. What are their key product innovations and industry leadership initiatives aimed at building this post-cookie advertising world?
Right. Underpinning all their channel-specific strategies is this broader, incredibly ambitious goal to architect the foundational infrastructure of the post-cookie open internet. This involves several key initiatives working together. Firstly, and perhaps most importantly, is Unified ID 2.0, UID2.
UID2. Okay, tell us more about that.
The Trade Desk is the primary architect and easily the most vocal proponent of this open-source identity framework. It's specifically designed to replace the third-party cookie for user identification.
How does it work?
By creating a new industry currency based on authenticated, but importantly, privacy-conscious user data, typically hashed and encrypted email addresses or phone numbers, obtained with user consent, TTD aims to solve the identity challenge for the entire open internet in a way that respects consumer privacy.
But it needs others to adopt it, right? It's open source.
Absolutely critical. Gaining broad adoption from publishers who implement it, data providers who transact on it, and advertisers who target using it across the entire ecosystem is absolutely critical to its success. If it succeeds, it would firmly cement TTD's central, almost indispensable role in the new digital advertising ecosystem. They'd be facilitating the core identity layer.
Okay, so UID2 is one major piece. What else?
Secondly, there's OpenPath and the strategic Sincera acquisition. OpenPath is an initiative designed to simplify and improve the programmatic supply chain. It aims to create more direct connections between advertisers using the Trade Desk's platform and premium publishers.
Cutting out middlemen.
Essentially, yeah. disintermediating some of the traditional middlemen in the ad exchange process, which should increase transparency and efficiency for both buyers and sellers. The goal is to ultimately put more of the ad dollar into the publisher's pockets, which incentivizes better content and improve ad quality and performance for the buyer.
And the Sincera acquisition.
The acquisition of Sincera, which was a digital advertising data company back in late 2024, is intended to rapidly accelerate this open path effort. Sincera provides objective, actionable insights into the quality, efficiency, and overall health of the programmatic supply chain. It helps identify waste or fraud. So it's about optimizing the entire journey of an ad impression from buyer to seller.
Got it. Anything else on the innovation front?
And then there's Deal Desk. This is currently in beta testing with major partners like Disney. Deal Desk is a new, innovative feature within the Kokai platform that uses their powerful Koa AI-powered forecasting to revolutionize how advertising deals, those pre-negotiated agreements for specific ad inventory at set prices, are managed.
Okay.
It aims to improve the performance of these deals and even rescue underperforming ones by intelligently rerouting ad spend in real time to more efficient alternatives on the open market if the deal isn't delivering. It's all about ensuring that no ad dollar is wasted on suboptimal placements, even within these prearranged deals.
This really isn't just about iterating on an existing product, is it? It feels like TTD is actively trying to shape the very rules of the game for the entire industry, not just playing by them. It's a huge swing, almost a bet on their ability to rewrite the future of online ads.
It absolutely is. That's a great way to frame it. Their strategy extends far beyond simply participating effectively in high-growth markets. Through ambitious initiatives like UID2 for identity, OpenPath for supply chain efficiency, and the truly audacious Ventura OS for the CTV infrastructure itself, the Trade Desk is actively attempting to build, standardize, and influence the core infrastructure of the next era of digital advertising. Success in these ventures wouldn't just strengthen their current position, it would potentially transform the company from being a leading application provider within the current ecosystem to becoming a foundational architect of the future ecosystem. That would significantly expand its economic moat and long-term influence across the entire open internet. They are genuinely trying to be the essential connective tissue.
That's a truly forward-looking and incredibly ambitious vision. But even a company with such grand ambitions and a strong track record faces bumps in the road, right? What have been some of the most significant recent developments and challenges for the Trade Desk, especially over the pretty dynamic period of 2023 and 2024?
Yeah, dynamic is a good word for it. The period from 2023 through 2024 has indeed been quite challenging in some ways for the Trade Desk. It was marked by significant product launches and strategic moves like Kokai and Ventura, absolutely, but also by macroeconomic headwinds, a rare operational stumble, and intensifying competitive and regulatory pressures. It hasn't all been smooth sailing.
Let's talk about the economy first. How has the slowdown impacted them?
First, let's consider the pervasive impact of the economic slowdown we saw. As a company whose revenue is directly tied to advertising budgets, the Trade Desk is inherently sensitive to the broader economic climate.
Sure, ad budgets get cut first sometimes.
Often, yeah. Throughout 2023 and into 2024, macroeconomic uncertainty, things like persistent inflation, rising interest rates, concerns about a potential recession, it weighed heavily on the broader advertising industry. TTD's management even acknowledged in mid-2025 that some of the world's largest brands, which are key clients for them, were facing significant pressures from factors like tariffs, supply chain disruptions, ongoing inflation, and that led to more deliberate, more cautious, and sometimes just reduced ad spending. So a headwind for growth. Definitely. This kind of environment creates a natural headwind for growth and can lead to increased volatility in quarterly results, even for a clear market leader like TTD.
And speaking of volatility, they actually had a very rare misstep recently, something quite uncharacteristic for them, didn't they, in late 2024?
They absolutely did, yes. In a significant development that really caught investors and analysts off guard, the Trade Desk reported in its Q4 2024 earnings release that it had missed its own internal expectations. And this was for the first time in an astonishing 33 quarters as a publicly traded company.
33 quarters, that's over 8 years.
Exactly. 8 years of meeting or beating expectations. So the news was quite a shock to investors who had really grown accustomed to almost flawless execution from them. And it resulted in a sharp, immediate decline in the company's stock price at the time.
What did they say caused it?
Well, CEO Jeff Green openly attributed the shortfall to a series of small execution missteps. He said they occurred while the company was undergoing a major internal reorganization, realigning teams, changing processes, and simultaneously managing the extremely complex, large-scale global rollout of its new Kokai platform.
So trying to do too much at once, maybe?
Perhaps. This incident, while it turned out to be relatively brief, really does highlight the inherent execution risk that even a high-growth, well-managed company faces, especially when operating in a fast-changing environment and trying to scale complex processes globally. Even the best companies can stumble when navigating such ambitious transformations.
So how did they recover from that rare stumble? Did they manage to quickly regain their footing and reassure the market?
They did. Following that Q4 disappointment, the company demonstrated a remarkably strong and swift recovery, actually. In its very next earnings report, Q1 2025, the trade desk significantly beat analyst expectations for both revenue and profitability.
Okay, good sign.
Yeah, it signaled to the market that the previous quarter's issues may indeed have been transitory and primarily related to that internal execution shuffle, not some fundamental flaw in the business itself. A key highlight they pointed to was the accelerated adoption of the new Kokai platform.
So Kokai adoption helped.
Management reported that roughly two-thirds of clients had migrated to the new system ahead of schedule in Q1. By the time they reported Q2 2025 earnings, that figure had increased to approximately three-quarters of all client spend, with full adoption across the client base expected by the end of the year. The rapid, successful rollout and the positive performance metrics they were reporting from Kokai were crucial in restoring investor confidence and proving their ability to execute on these big strategic initiatives.
Okay, so they bounced back. But even with that recovery and strong performance, competition in this space must be absolutely relentless. Who are their biggest, most persistent competitive threats right now, especially as new trends like retail media emerge?
Competition has indeed remained a persistent and, frankly, intensifying challenge. The continued explosive growth of retail media networks, led primarily by Amazon's formidable DSP,
Amazon
has become a primary focus for investors and analysts when assessing TTD's competitive landscape. Amazon's vast trove of first-party shopper data, that data about what people actually buy, and its deeply integrated e-commerce platform represent a truly significant competitive threat.
Hard to compete with Amazon's data.
It is. Now, while the trade desk continues to argue, quite convincingly I think, that its independent objective model is a key long-term advantage, the sheer scale, the resources, the direct customer relationships of competitors like Amazon and Google with their trillion-dollar-plus market caps simply cannot be underestimated.
Yeah.
It's a constant battle of titans.
And we can't forget about regulatory scrutiny either, can we? It feels like ad tech is constantly in the crosshairs of governments around the world.
Not at all. That's another persistent shadow. The entire ad tech industry continues to operate under the threat of potential regulatory action, both here in the U.S. and internationally. The U.S. Department of Justice's ongoing antitrust lawsuit against Google, for example, has brought significant attention to the competitive dynamics and alleged anti-competitive practices, specifically within the programmatic advertising market.
Could that actually help TTD if Google is weakened?
It's possible. While a weakening of Google's market power could theoretically create opportunities for independent players like the trade desk by leveling the playing field, it also raises the risk of broader, industry-wide regulation. New rules could impact all participants, including TTD, maybe restricting data usage or imposing new compliance costs. Navigating this increasingly uncertain legal and regulatory landscape remains a key and complex challenge for management. A single new law or ruling could significantly alter the operational environment for everyone.
So, what does this all mean for the trade desk? They've shown impressive resilience after a rare hiccup, certainly, but the competitive pressures from giants and the regulatory pressures are very real and probably not going away. It truly is a high-stakes game they're playing.
Absolutely. High stakes, high rewards, high risks.
We've covered a lot of ground today, from their innovative technology and business model to their strong financials and really ambitious strategies for architecting the open internet. But with any high-growth company, especially one trading at a premium valuation, which we'll get to, it's absolutely crucial to understand the risks. What are the main things that could realistically go wrong for the trade desk, the potential pitfalls that investors really need to be aware of?
Yeah, understanding the downside is just as important as understanding the upside. An investment in the trade desk definitely involves exposure to a range of material risks. These are inherent to the ad tech industry itself, the company's specific market position, and the broader macroeconomic and regulatory environment. They should certainly be carefully considered by anyone looking at the company.
Okay, what's risk number one?
First, there's the unavoidable market and macroeconomic risk. The company's financial performance is highly correlated with the overall health of the digital advertising market. We touched on this.
Right. Ad budgets are often discretionary.
Exactly. They're among the first line items to be potentially reduced or put on hold during periods of economic uncertainty, high inflation, or recession. So a sustained economic downturn would likely lead to reduced ad spend from clients, which would directly and materially impact the trade desk's revenue and profitability. Furthermore, the market for programmatic advertising itself, while clearly growing, is still evolving. If it develops more slowly or perhaps differently than anticipated.
Like if advertisers shifted back towards direct deals with publishers.
Or if some unforeseen technology disrupted the programmatic model, then TTD's growth could certainly be harmed. They're betting heavily on programmatic continuing its trajectory.
Makes sense. What's next?
Then there's competitive risk, which is always top of mind in this space. The trade desk operates in an intensely competitive market. Its most significant competitive threats, as we've discussed, come from those large integrated walled garden platforms, particularly Google's own demand-side platform, DV360, and Amazon's rapidly growing DSP.
The giants.
The giants. These competitors possess massive scale, extensive first-party data assets like search history or purchase data, and the ability to bundle advertising services with other essential business products like cloud computing or e-commerce fulfillment. That creates significant competitive pressure and potential ecosystem lock-in for advertisers.
Hard to compete with bundling.
It can be. While the trade desk's independence is a key differentiator, the sheer scale and virtually limitless resources of these tech giants represent a persistent and formidable risk that can never be entirely discounted. They can always buy, build, or subsidize competitive offerings if they choose to focus there.
Okay. What other major risks?
We also have technology and privacy regulation risk, which is kind of a double-edged sword for the entire industry right now. The industry-wide deprecation of third-party cookies creates a fundamental technological challenge. The success of the trade desk's primary response, that Unified ID 2.0 initiative, well, its success is not guaranteed.
Right. It depends on others adopting it.
Critically depends on widespread voluntary adoption across the industry, publishers, advertisers, other tech platforms. That's a monumental undertaking. A failure to establish a viable, broadly adopted alternative to cookies could significantly impair the effectiveness of ad targeting and measurement on the open internet, which would obviously harm TTD's core value proposition.
And the regulatory side of that.
Furthermore, the global landscape of data privacy regulation is incredibly complex and constantly changing. Think GDPR in Europe, various state laws in the U.S. Stricter laws could increase compliance costs for TTD, restrict the use of data for advertising purposes, and limit the company's ability to operate and expand in certain key jurisdictions. It's a minefield they have to navigate carefully.
Okay, that's a big one. Anything else stand out?
Another important consideration is client concentration risk. While they have thousands of end advertisers, a substantial portion of the trade desk's gross ad spend is actually generated through the major advertising agency holding companies. The big names like Publicis, WPP, Omnicom, Dentsu, IPG.
So the agencies funnel a lot of the spend.
A very significant amount. While the end advertisers are diverse, this concentration of actual spend within a few large agency networks means that the loss of, or even just the significant reduction in spend from, one of these major holding company clients could have a material adverse effect on the company's financial results.
And are those relationships exclusive?
Generally not. It's also worth noting that the company's relationships with these agencies, while deep and often long-standing, are typically not exclusive. These agencies are free to work with other DSPs as well, maybe even competitors like Google's DV360, adding another layer of risk.
Okay, one more.
Finally, there's key personnel risk. This is often overlooked but can be critical for founder-led companies. The trade desk's success, its strategic vision, its overall direction are heavily influenced by its co-founder and CEO, Jeff Green.
Right, the visionary leader.
He's not just the leader. He's a recognized pioneer in the ad tech industry. And crucially, he holds significant voting control over the company through those dual-class shares we'll talk about. The unexpected loss of his leadership due to retirement, illness, any other reason would create substantial uncertainty and could significantly disrupt the company's strategic trajectory and operational execution, especially given his central personal role in driving industry initiatives like UID2 and Ventura.
Okay, those are definitely some very real risks to keep in mind. It reminds us that even great companies operate in a challenging world. Now, let's tackle one of the trickiest aspects for any high-growth company, its valuation. How does the trade desk stack up when we look at its current and historical trading multiples? Is the market paying a premium? And if so, why? Does it seem justified?
Yeah, valuation is indeed a central component of the investment debate around TTD, and it often sparks pretty intense discussion. The company has consistently traded at premium multiples relative to both its direct ad tech peers and even the broader software as a service or SaaS industry.
Always been expensive, basically.
Pretty much. This reflects the market's high expectations for its future growth, its perceived market leadership position, and its consistent profitability. An analysis of its valuation reveals that while there has been significant multiple compression from the really exuberant peaks we saw in, say, 2020-21.
Right, when everything tech was flying high.
Exactly. Even after that compression, the stock continues to command a substantial premium over most of its competitors and the market average.
Can you give us some specific numbers as of recently?
Sure. To give you some specifics from early September 2025, the trade desk's trailing 12-month GAAP, that's generally accepted accounting principles, the standard accounting rules, price to earnings, or PE ratio, stood at approximately 62.7 times.
63 times earnings. Okay.
Which is substantially higher than the communication services sector median, which is maybe around 21 times. That sector includes many mature, slower growth companies, of course.
Right. What about revenue multiples?
Its trailing 12-month enterprise value to revenue, or EV revenue, multiple is approximately 8.8 to 9.0 times. Now, while this is a significant contraction from its peak, believe it or not, it peaked at 51.1 times EV revenue at the end of 2020.
51 times revenue.
Yeah. Even at 9 times, it remains well above the median EV revenue multiple for the ad tech sector specifically, which stood at a much lower 2.7 times in late 2023.
Wow, 9x versus less than 3x for its peers.
Big difference. And its trailing 12-month enterprise value to EBITDA, or EV/EBIT multiple, is approximately 43.5 times. Again, this represents a steep decline from its 5-year average, but it's considerably higher than the ad tech industry median, which was around 14.2 times.
So consistently much higher multiples.
Yes. The historical data clearly shows that while the multiples have certainly moderated from potentially unsustainable highs, the market continues to value the trade desk as a best-in-class asset with superior growth prospects and a durable moat compared to its immediate industry peers.
That's a massive premium over its direct industry peers. But with all the macroeconomic headwinds and intense competition from giants that you just outlined, is the market perhaps being overly optimistic here? Or is there a less obvious justification for this valuation that the bears might be missing? How does TTD compare to other types of companies then, not just ad tech?
Yeah, that's the key question. To contextualize the trade desk's valuation and try to understand that premium, it's useful to compare it against several distinct peer groups. First, as we mentioned, the direct ad tech peers.
Sure.
This group includes other publicly traded ad tech companies like, say, Pamatic or Magnite. These companies generally have different business models. Some are supply-side platforms, helping publishers sell ads, not buyers buy them. And they tend to exhibit lower growth rates and less consistent profitability profiles. And that's directly reflected in their significantly lower valuation multiples. We saw TTD at maybe 9x EV revenue. Pubmatic might be around 1.1x, Magnite maybe 5.6x. This comparison really highlights TTD's perceived superior quality and market position within ad tech.
Okay, so it looks great compared to other ad tech. What about software?
Right. Second, SaaS platform peers. Because of its consistently high gross margins, its highly scalable platform model, and its sort of recurring revenue characteristics as clients tend to increase spend over time, the trade desk is often benchmarked against high-growth enterprise SaaS companies.
I do.
The peer group used for its own executive compensation benchmarking in its 2024 proxy statement included names like Cloudflare, CrowdStrike, Datadog, Snowflake, Shopify, really top-tier high-growth software names. Now, while these companies also trade at premium multiples, the median revenue multiple for public SaaS companies generally is around 4.25 times currently, which is still considerably lower than the trade desk's 9 times, although some individual names in that group, like Snowflake, which trades around 24.5x EV revenue, are much higher and actually closer to TTD's multiple.
So still high even compared to many SaaS companies.
Generally, yes. This comparison suggests the market sees TTD more like a high-quality platform software company rather than just a commoditized ad tech vendor.
And finally, how does it compare to the walled gardens themselves? Google, Amazon.
Third, walled garden competitors. Comparing TTD to Alphabet, Google, and Amazon is also instructive, as their advertising segments are TTD's primary competitors, even if they have different overall business models. While these are much larger, more diversified businesses, their advertising revenue often represents a significant portion of their overall business. They typically trade at lower multiples than TTD.
Why is that?
Reflecting their more mature status, slower overall growth rates across their vast operations, and perhaps factoring in those inherent conflicts of interest we discussed. For instance, Alphabet might have an EV revenue around 6.8x, Amazon around 3.8x, both generally lower than TTD's 9x. This suggests the market values TTD's focused, independent growth trajectory more highly in its specific niche, despite the scale of the giants.
So we're seeing a consistent trend here. The trade desk commands a significantly higher valuation than almost all its direct ad tech peers, and even many high-growth SaaS companies, let alone the giant walled gardens it competes with. What are the core arguments, the bull versus bear case, for and against this persistent premium valuation? It sounds like there's a strong bull case based on quality and growth, but the bears must have some valid points too, right?
Oh, absolutely. The analysis of the trade desk's valuation truly presents a clear dichotomy, a fascinating debate between bulls and bears. The bull case for the premium valuation rests heavily on the argument that the trade desk is simply not a typical ad tech company, nor should it be valued as such.
It's viewed as a high-growth, highly profitable market leader with a durable competitive moat, uniquely and strategically positioned to benefit from some of the most powerful secular trends in media and advertising, namely that shift to programmatic CTV, the rise of retail media, all while actively trying to architect the future identity layer of the internet with UID2.
So quality justifies the premium.
Proponents would argue that comparing its multiples to slower-growing, less profitable ad tech peers is just inappropriate. They'd say its valuation should be considered in the context of other best-in-class disruptive software platforms that are addressing and disrupting massive addressable markets. The premium, in their view, is justified by its stellar execution track record, its clear market leadership position, and its vast future potential in a trillion-dollar ad market.
Okay, that's the bull case. What about the bear case? Why might this premium be too high?
The bear case, conversely, argues that even after the significant multiple compression we've already seen, the current multiples still do not adequately compensate investors for the inherent risks involved.
The risks we just discussed.
Exactly. The advertising industry is, by its very nature, cyclical and subject to macroeconomic swings. Competition from trillion-dollar companies with vast resources and data advantages is undeniably intensifying. And the technological landscape is fraught with uncertainty, particularly around cookie deprecation and the ultimate success and adoption of new identity solutions like UID2.
So, too much uncertainty for such a high price.
From the bearer perspective, yes. They'd argue the stock is priced for near-perfect execution, leaving very little margin for error in the face of potential macroeconomic headwinds, unexpected competitive pressures from Amazon or Google, or maybe a stumble in executing its very ambitious innovation roadmap like Ventura. It's truly a debate about the strength and impermeability of their moat, their ability to continue executing flawlessly in a very challenging environment, and ultimately whether that future potential, however large, is already more than fully priced into the stock today. #TAG9STRAC. Management quality and corporate governance.
Okay, given those high stakes, the incredibly ambitious vision and that persistent premium valuation, the quality of leadership and the corporate governance structure become incredibly important, right? Who's actually at the helm of the trade desk, and how is the company structured to ensure long-term success and accountability?
Yeah, absolutely. The quality of a company's leadership and the robustness of its corporate governance structure are critical factors in assessing its long-term investment potential. This is particularly true for a high-growth, high-multiple company like TTD. And the trade desk is indeed led by its visionary founder, Jeff Green, and benefits from an experienced management team and board, though its governance structure does concentrate significant control, which is worth noting.
Tell us more about Jeff Green. He seems central to the story.
He really is. Jeff Green, the company's co-founder, chairman, and CEO, is truly a central figure in the investment case for the trade desk. He is widely regarded as a genuine pioneer in the ad tech industry. He previously founded EdECN, which was actually the world's first online advertising exchange way back, and he successfully sold that to Microsoft in 2007.
So he's been in this game a long time.
Decades. His deep, long-standing industry expertise, his strategic foresight demonstrated over many years, and his long tenure leading TTD provide the company with consistent and undeniably visionary leadership.
And what is his core vision, would you say?
His strategic vision is very clear and has been remarkably consistent for years now. It's to build the dominant independent platform for the open internet. providing a transparent and efficient alternative to those opaque walled gardens. He is a very vocal and influential advocate for this vision in the broader industry, often speaking quite passionately about the importance of objectivity, data-driven decisioning, and fostering a fair, open marketplace for both publishers and advertisers.
And he has skin in the game.
Oh, yes. His significant ownership stake, particularly his control of the high-vote Class B shares, ensures that his interests are very strongly aligned with the long-term success of the company. It incentivizes sustained growth and value creation rather than just focusing on short-term gains.
So a strong visionary founder with clearly aligned interests, that's often seen as a powerful asset, especially in tech.
Yeah.
What about the rest of the leadership team and the board supporting him? Do they have the depth of experience needed to execute on such a grand global vision?
Absolutely. It's not just a one-man show. The trade desk has assembled a deep and highly experienced senior leadership team to support its ambitious growth plans. The executive ranks include individuals with extensive backgrounds at major technology, media, and enterprise software companies. Names like Salesforce, Oracle, IBM, Univision come up.
Impressive resumes.
Yeah. And the company has also made several key appointments recently to bolster its operational and financial leadership. For instance, Vivek Kundra as Chief Operating Officer. He was formerly the first U.S. CIO under Obama and later an executive at Salesforce. Alex Kayal, as Chief Financial Officer, came over from Salesforce Ventures. And they recently added Omar Tawakkol to the board. He was the founder of ad tech firm BlueKai, which Oracle bought, and now runs an AI company.
So bringing in serious operational and financial muscle.
Exactly. These hires bring in valuable experience in scaling large, complex technology organizations globally and navigating intricate industry landscapes. The board of directors itself is composed of a diverse group of seasoned executives and investors, with members having experience from prominent organizations like Google and top-tier IPO advisory firms, providing a broad range of expertise and oversight to management.
And how is that leadership team compensated? Are their incentives truly aligned with shareholders, especially given that focus on long-term vision rather than just quarterly results?
Yeah, the compensation structure seems designed to reflect that. The company's executive compensation program aims to align the interests of its leadership team with those of shareholders. It utilizes a thoughtful mix of base salary, performance-based cash incentives that are tied to specific operational and financial metrics laid out each year, and substantial long-term equity awards, mostly in the form of stock options or restricted stock units that vest over several years.
Any notable features there?
A particularly notable aspect of their compensation philosophy was that exceptionally large, purely performance-based stock option award granted to CEO Jeff Green back in 2021. This grant is specifically tied to the achievement of really ambitious and sustained stock price hurdles over a 10-year period. It strongly incentivizes the creation of significant, durable, long-term shareholder value, not just short-term bumps. The Compensation Committee also engages an external compensation consultant to help benchmark its pay practices against a peer group of other high-growth technology and software companies to ensure competitiveness and fairness.
Okay. Finally, let's talk about corporate governance itself. Are there any unique aspects to how the trade desk is governed, particularly concerning shareholder control and influence?
Right. The trade desk has established formal corporate governance guidelines. These mandate things like a majority independent board of directors and require regular executive sessions where these independent directors meet without management present. The company also maintains a clear code of conduct and ethics that applies to all employees and directors. Standard good governance practices there. However, a primary governance consideration for investors, and one that often generates debate, is the company's dual-class stock structure.
The dual-class structure. Explain that.
The Class B common stock, which is primarily held by CEO Jeff Green, carries 10 votes per share. That's compared to just 1 vote per share for the publicly traded Class A common stock that most investors hold.
10 votes versus 1. So Jeff Green has disproportionate voting control.
Significantly so. This structure effectively concentrates voting power very heavily in the hands of the founder and CEO.
Okay, so what does this all mean for you, the investor? While strong, visionary leadership like Jeff Green's can certainly be a huge asset, especially for executing a consistent long-term strategy, it's absolutely worth considering how much power rests with a single individual, even a brilliant and aligned one.
Exactly. This dual-class structure can be viewed positively, right? It provides stability. It allows management to focus on long-term strategy without being constantly buffeted by short-term market pressures or activist investors who might push for different priorities.
Yeah,
That can be good.
but the downside.
But the downside is that it also significantly limits the influence of public shareholders on corporate matters. Things like the election of board members or votes on major strategic decisions like large acquisitions or even the sale of the company. So it represents a key governance risk that investors need to be acutely aware of and weigh carefully against the potential benefits of that strong founder-led vision and stability. Hashtag tech outro.
Wow, what an absolutely incredible deep dive into the trade desk. We've truly unpacked a fascinating and really complex story today, haven't we?
We certainly covered a lot of ground.
We've seen how TTD positions itself as the industry's largest independent demand-side platform, that powerful, objective alternative to the colossal tech walled gardens that often dominate the digital advertising landscape.
We explored its core business model, meticulously built on those principles of objectivity, omnichannel reach, and deeply data-driven decisioning, all fueled by its incredibly innovative Kokai platform and that Koa AI engine working underneath.
We also dove deep into the immense market opportunities presented by the huge structural shifts happening in connected TV and the, frankly, explosive rise of retail media networks, both trends which seem to play directly to TTD's unique strength.
And we saw how they're trying to navigate the industry's greatest challenge, that deprecation of third-party cookies, by actively championing new, privacy-centric identity solutions like UID2, attempting to build the future rails.
Their financial track record looks robust, demonstrating strong, consistent growth and impressive profitability, reinforced by those almost unheard-of client retention rates we keep coming back to.
Yeah, that 95% plus for 11 years is sticky. And their truly ambitious strategic vision to really architect the very infrastructure of the open internet through initiatives like UID2 and that audacious Ventura OS. It's truly a bold play for the future, a huge swing.
But as we meticulously detailed, it's certainly not without its challenges. We highlighted the inherent risks of a cyclical advertising market, the relentless, intensifying competition from trillion-dollar companies like Google and Amazon, the fundamental uncertainty around new privacy regulations, and the success of cookie alternatives.
And even some rare recent execution stumbles that remind us no company, no matter how good, is immune to operational hiccups when moving that fast.
Exactly. And while its valuation consistently commands a significant premium, reflecting incredibly high expectations for future growth and near-perfect execution, it also means there's inherently less room for error if things don't go exactly to plan.
True, the pressure is high.
Ultimately, though, understanding the trade desk provides such a critical lens, a truly invaluable shortcut, into the future of the entire digital advertising ecosystem. It shows us how the industry is moving beyond simply buying ads more efficiently to actively architecting the very infrastructure upon which all future digital commerce and content will likely be built.
It's a fascinating case study in ambition and execution.
It really is. And that leaves us with a provocative thought, something for you to perhaps mull over long after this deep dive ends. Considering the trade desk's aggressive push to build the fundamental infrastructure of the open internet and challenge the walled gardens, one might ask, if they truly succeed in becoming the indispensable connective tissue for all non-walled garden advertising, could they themselves, by owning the underlying technology and the critical data flow, inadvertently evolve into a new, albeit different kind of walled garden?
Interesting question. Owning the pipes, even if not the content.
Right. What implications would that have for the future of advertising transparency and competition in the long run? Something to think about.
Definitely food for thought.
Thank you so much for joining us on the deep dive today. We truly hope this exploration has left you better informed, perhaps more curious, and with a fresh perspective on this incredibly dynamic corner of the digital world.
Thanks for having me.
Until next time.